Hey guys, thank you for tuning in today to the Alan Nogier YouTube channel, and today's episode is going to be all about how to pick the right stocks to go from $1,000 to $5,000. Now before we get started, I want you to remember, smash that like button because it really helps me out and it tells everyone else that this YouTube video is worth watching. And as soon as you like it, smash that like button. If you know you're going to like it, then just do it right now. So now, how do you get $1,000 to become $5,000 in the stock market? It's important to know that if you can do this, all you got to do is add a zero and you can do as much as you want. We don't all start off that wealthy. That's okay. That's where the power of compounding comes in. You can make 1,000, 5,000. You make 5,000, 25,000, and 25,000, 125,000, and so on and so forth till the end of time. That's the power of compounding. Now, you don't believe me yet, but I guarantee you that by the end of this video, you're going to know how to do it yourself, and you're going to believe that it's possible, because I guarantee you it totally is. Now, the first thing you need to know is that investing in stocks, and honestly investing in anything, investing in stocks, real estate, a business, 10% of your success is based on what you buy. 10% of it is based on when you sell, and 80% of it is being patient and holding, thus making 100% of your success, because you will be 100% successful. The second thing you need to know is that you should place your love in buying, not selling. Too many people get trigger happy and they love to sell. And what happens when you sell too early? You jump the gun. You're too invested in the making money part that you lose sight of the patience. So love the part of buying and holding more than you love the selling. And I'm going to show you how to do that. Because when you start to learn about the numbers and how to pick something and why you're picking it, that's where the stock market and investing in anything really, that's where it becomes fun. Because you're like, wow, I see the numbers. I see how much money I can make. That's fun. Seeing the vision and then holding because you know what's going to happen. Now the third thing you need to know is how do you pick the right stocks? Right? What numbers do you need to know? What concepts do you need to know? How do you really dive deep to know if this stock is the one that's going to make me a bunch of money? There are millions of stocks out there. And I guarantee you, out of those millions, there's a lot of losers and a lot of winners. And how do you pick and buy the winners? Now, once you know how to pick the right stocks, from there, diversify. Pick more winning stocks. Rinse and repeat. Find all the stocks that work for you and diversify amongst them. And the last thing you need to know to go from 1,000 to 5,000 is when to sell. Too many people get trigger happy, they sell too early, and they don't really see the benefits. Today I'm going to show you how to do all of that, and you're going to love it. Now remember, as soon as you like something, smash that like, hit subscribe. Here we go. Meat and potatoes. The real info, the knowledge, the fun. Let's go. Now, if you remember, the first thing I said was making money in the stocks is 10% about what you buy, 10% about when you sell, and 80% holding. But just remember the holding part. Be patient. Do not listen to the emotions, the bombardment, the fear of missing out, the fear of losing a bunch of money. Stick to it. Hold. Reassess, run your numbers again if there's a little bit of fear, but never impulsively sell, never impulsively buy. Always run your numbers. And then once you're really good at doing this, trust me, I can do the numbers in my head like really fast. Like I look at something and it's like, oh, that's got a, probably like a 10 ARR. I'll tell you what an ARR is, asymmetric risk ratio. We're going to go over that in the numbers section. But once you're good, then you can make like a quick decision. But when you're starting, do not let impulse or emotion dictate what you do. Now, if you remember right, the second thing I said was do not get trigger happy. Do not love selling, love buying, and love holding. Because if you learn how to buy and hold and do that well, I promise the selling part, that will come. Do not place your love in that, because if you're like, oh, I can't wait to sell, you're gonna experience trigger happiness. Steer on the side of holding. Now this is why. Because if you sell too early, you don't maximize the effects of both compounding and the tax benefits. Now what do I mean? This is compounding. Let's say you have $10,000 in the stock market and you make 10% in that day. 10% for you is $1,000. You just went from 10,000 to 11,000. Now let's say the same exact change happens a month later. Another 10% and you're still at 11,000. 10% of 11,000 is 1,100. So the same change happened in the stock market, but because you've allowed your money to sit there and grow itself, that same change actually has a bigger impact on your portfolio. So now what happens when you allow this to continue is that the same linear changes that happen in the stock market actually have an exponentially greater and greater change on your portfolio and on the value of any stock, really. Now this is why investing is gold, because when you put your money in the bank or you're working at a job, you're adding in your life. You're adding to your bank account. And you know what the bank is doing with your money? They're investing it and exponentially receiving a return on it. And this is part of the problem in today's society as to why the rich are getting richer and the poor are getting poorer, because the poor keep working at a linear rate and the rich have been compounding exponentially, and as more money is being printed, they're getting more of this money, while the poor continue to make the same exact amount even though there's inflation going up. Like there's more money being printed, there's more wealth being generated than the rate at which poor people are adding to their bank accounts. And that's why they're getting poorer. And where does all that money go that's being printed, that's going through inflation? It goes into the pockets of people who are investing their money. Now I wish everybody knew about compounding and investing in these ways. And it's so accessible. It's on YouTube. And again, that's why you should smash that like button. Share it with your family, your friends, your everybody, because everybody should know this stuff. Because it is the key and the secret to having financial security. And then from there, once you have financial security, building financial freedom. And from there, building financial freedom, building massive wealth. Now, the second reason it's so important to love buying and holding, 80% holding, right, is because there is a tax benefit if you hold longer than a year. If you sell within a year, that profit that you made on that stock is now subject to capital gains tax of the short form. That is short-term capital gains. Now, if you hold for a whole year, that profit that you make on the stock is now subject to long-term capital gains tax, which is much nicer. The general rule of thumb is that short-term capital gains tax is going to be 37% of profits, not of the total amount you sold, but only the profits. And long-term capital gains tax is about 15%. So you're almost doubling the amount of taxes that you're paying for selling it within a shorter time frame. Now, I'm not going to go into too much detail here, but I will make a YouTube video in the future describing how you should be investing depending on what tax bracket you're in. For example, if you're a student and you don't have a job and all you do is you decide to trade, then by all means, go ahead and do some short-term capital gains and sell them within a year, because you're not going to be affected by that 37% taxation. It's going to work a little differently for you. But for now, just assume that you still want to adopt the concept that you're buying and holding, regardless of the tax, whatever tax bracket you're in, because eventually you're going to be in the 37% tax bracket. For that reason, you'd rather hold long-term and go with the 15% capital gains tax. Now let's go ahead and move on to my favorite section, which is the numbers. Why are numbers my favorite thing? Because money come in the form of numbers. If you understand numbers, you understand money. As easy as plus, minus, multiplication, and division. If you understand all of those things, you understand how to make money, how to make the best kind of money, how to make the best deals, the best decisions, the best business decisions, the best investment decisions, you name it. Numbers are the key. Now, what numbers do you need to know to pick stocks? The first and most important number when picking stocks is always minimize your downside. Never set yourself up to lose money. This is the problem that people who lose money in the stock market or in any investment have. What happens is they invest in something and they don't realize that their downside is huge. And thus, by putting their money in, yes, they can make a lot of money, but they can also lose a lot of money. And smart investors do what's called asymmetric risk aversion. That is, they asymmetrically are risk averse, meaning they're averse from losing a downside, any kind of downside. If you can have 0% chance of losing, you want to get as close to that as possible. And from there, they're asymmetrically leaning towards a strong upside. So when you have low downside, strong upside, that is what we call an asymmetrically risk-averse investment. Three things that we just talked about there: a downside, upside, and the ratio between the two, which is called an ARR, an asymmetric risk ratio. Now, we're not going to get into too much detail how to figure it out, because that would take a long time. But I guarantee you, once you know the concept and you start looking at numbers on the stock market, you're going to start to figure it out really quickly, because it's kind of intuitive. For example, if you buy something really low, when it's at a low price point because it's suffering, but you know it's going to go straight up from there, well, chances are it's got a very low downside. Now, if you buy something when it's like there's hype around it, like it's super huge right now, they're priced pretty high. I bet you look at their PE ratios, they're higher up, their price per earning. I'm getting too deep. Now, just remember, focus on minimizing your loss. You can derive your downside two ways. You can look at the historical data, and you can look at the balance sheet and projections from there, right? How much cash flow are they earning year after year, right? What exactly set them back? And then take a best guess as to what you think the actual value of the stock should be. Start looking at stocks and just trying to figure it out. And I guarantee you, when you put your mind to it, it becomes pretty intuitive. You'll figure out a way. But look for the downside. And my rule of thumb is always, always that the downside should be less than 20%. I will never invest in a stock that has more than 20% downside. For example, if I have to put $1,000 into it and it has a 50% downside potential, that means I could lose $500. Now, I never invest in a stock with that much downside, because remember, there are millions of stocks. You don't have to compromise with yourself. Stick to your numbers and say, I'm not going to invest in a stock that has greater than 20% downside potential. Never pick more than that. Rule of thumb for beginners. Now, for upside potential, my rule of thumb is always pick a stock with 200% upside potential or more. Now, how do you get the upside potential of a stock? Well, for the purposes of this video, I'm going to tell you just to go to stocks, look at them, and try and figure it out. Two general ways, which is, just to give you some guidance, historical data and projected data. Past, present. The price is what it is now. Where has it been? Where is it going? So now, both of those rules of thumb are that 20% downside, 200% upside. What does that number come out to? That ratio ends up coming out to be 10. 200 divided by 20 is 10. That right there is what we call the ARR, the asymmetric risk ratio. When you divide your potential gain by the risk that you're taking by the downside. Divide them both together and you get a number, which is the ARR, the asymmetric risk aversion ratio. Now the ARR is a beautiful number because you can set that to whatever you'd like. I currently only invest in ARRs of 10 or more, but when I was starting and it was harder to pick them out and to know for sure, I was picking ARRs of 5 or more. And even 5 or more is still really good. That's like saying it's a 20% downside with 100% upside. Now forgive the camera change here as my poor camera has reached the end of its life. Now in lieu of this moment, let's go ahead and take a moment to smash that like button, hit subscribe, and show your support for that camera and its help in what it's doing for me. Where were we? Oh yeah. Never invest in stocks lower than a 20% downside, and never invest in stocks lower than 200% upside. And then from there, the less you can minimize the downside and the more you can maximize the upside, and the further that these two numbers are from each other, that is what we call the spread. The bigger the spread, the better. If you have a stock that's 20% downside and 200% upside, well, that stock is not going to be as good as the stock that's 20% downside and 500% upside. You want the stock with the greatest amount of spread and with the lowest downside, highest upside, aka again, spread. To summarize that section, there were 4 things you need to calculate when looking at the numbers, and there's a bonus 5th, but this is a little bit more advanced. But the 4 are: you need to calculate your downside, calculate your upside, calculate your ARR, your asymmetric risk ratio, and calculate your spread. Based on these 4 things, which are all interconnected, you will determine whether you should invest in the stocks. And again, the rule of thumbs are no more than 20% downside, more than 200% upside, more than a 5 ARR ratio, and greater than a 220 spread, right? Because 20 and 200, right? Now, the 5th bonus thing is, for example, go to Wall Street Journal, look up the stock, and look at the balance sheet. Look at their income statements, look at their cash flow, look at their assets, and determine, just look at their business model. Is it working? Are they making money every year? Or are they like losing money heavily? Obviously, if they're losing money, you don't want to go there. Or maybe they have a ton of assets. Or maybe they're growing their liabilities, but behind the scenes, you see that the liabilities are growing, but their assets are growing faster, which means they're really good at leveraging debt. Ton of things to be looking for when you're looking at a balance sheet, but that's for another video. Now, the last thing we need to do is, when do we sell the stock? Well, first, just know we're going to hold. Well, you're probably going to be ready to sell once that stock has done what I call popped. That is 100% return. And then even then you still hold because you're like, wow, there's power here, 100% return. And then you have the effects of compounding at this point, which take you to 200. When you're at 100% return, the next time the stock goes up 50%, you go up 100%. And then from there, when it goes up another 100%, you go up 200%. It's just a compounding effect. It's a huge snowball once you get up to those numbers. That's why it's more of a hold. You want to go for the hold. You don't want to go for the quick sell. Hold, and always assess. Is there more here? You'll determine what's best. I just know that most people sell far too early. From there, my friends, I hope this was helpful. I want you to click and smash that like button and subscribe to my channel for more information like this. Remember, I've promised a few upcoming videos in this very video, which is how to read a balance sheet. What are the tax benefits? Eventually, we're going to be getting into real estate and how to do that, how to run numbers on that, how to make money on that, mindfulness trick, millionaire habits, things that you need to keep in mind to be driving your business to the next level, to be driving your investing to the next level, to be driving your life to the next level. Live your life how you want, my friends. Never settle. Always become more, do more, achieve more in your life. From there, namaste. Remember, smash that like button, hit subscribe, Tell that YouTube algorithm that I am your best friend, and that way more people will get a chance to interact with this level of information. Have a great day, great night whenever you're watching this, and I'll see you on the next episode.